Hi, Sam Carroll here. Sorry to interrupt your regularly scheduled cat videos with something a little more serious, but there's something you're going to want to know about. Here we are in July 2019 with the US stock market near all-time highs. And I'm seeing the same warning signs today that I saw ahead of the 2008 financial crisis. So if you have any investments, any savings, any debts, you're going to want to understand what might be ahead and what you can do about it. And that's the good news. There's a lot you can do about it. And I'm going to cover a lot of that in this video, so stay tuned. First, a disclosure. I'm reading from a script here, which may be obvious, but I want to get all the information in. I've been rehearsing this video, and it's taking me 10 minutes to get the message out, and it's not exactly an exciting 10 minutes, but I do hope to make these videos entertaining going forward, but today I'm just trying to get the message out, so bear with me. I'm heeding the advice of LinkedIn founder Reid Hoffman, who said famously, "If you're not embarrassed by the first version of your product, you've launched too late." So here we are, video one. Let's just get to it. So here's the warning. Today looks a lot like 2007 in terms of unprecedented and unsustainable debt in our financial system, which has been driving stocks and bonds and real estate prices to unsustainable highs. And now there are signs that the party will come to an end. The Treasury yield curve has inverted, which is a warning sign that has been followed by a recession almost every single time in the last century. And the bond market is signaling trouble as well. Lower quality bonds have been dropping in value relative to higher quality bonds over the last several months. Lastly, the stock market is showing signs of topping, and that tends to be a forward-looking indicator of difficulties to come. But don't panic. Panic is not a good look, and you've also got some time, if history is any indicator. Maybe 18 months, 24 months, maybe 30 months. Usually these signs precede a decline by that measure. So there's some things you can do also to prepare yourself for different circumstances, shall we say. Nothing drastic, just do the things that are wise under any circumstances. Some financial wisdom has been lost these days, so how about we fix that? Here's some ideas to get your financial house in order. 1, maximize your income. Now is a great time to get a better job when there's high demand for qualified workers and the labor market is strong. 2, track your expenses. Yeah, it's kind of boring, it's tedious, but it's worth it. Build and maintain a budget. I mean, personally, I use Google Spreadsheets, but there are a lot of really great tools out there where you don't really have to do much of the work. You just plug in your info and it gives you a picture. I'll get into that in coming videos. 3, maintain a savings account with at least 6 months of life expenses. That's likely to involve tens of thousands of dollars, so now might be a good time to get started. Some of you might think that's a lot of money to keep in savings, but consider this. Most job losses don't happen out of nowhere. They tend to happen during a recession, and the stock market tends to sell off ahead of a recession. So if you're unlucky enough to lose your job, you don't want to be in a position where you have to sell your stocks at a loss or near a market bottom just to pay for your living expenses. Some savings that provides the kind of buffer that you may need. 4, if you hold investments, make sure you're fully diversified. So what does that mean? Well, if you want to keep things simple, just consider buying index funds of the overall stock market and bond market. If you're into buying individual companies, stocks, and bonds, own at least 20 of them across different sectors of the economy, or at least make sure none of them amounts to more than 5% of your holdings. Diversify. Across all of your investments, you might want to hold your age in bonds. What that means, for example, if you are 30 years old, you might want to consider holding 30% of your liquid assets in bonds and have the remaining 70% in stocks. So bonds are more stable in value than stocks are. Stocks are riskier. So as you grow older, by holding your age in bonds, you're actually making your portfolio more stable as you approach retirement, which is great because as you're approaching retirement, if the stock market takes a big dive, you have much less time to recover. So my intention here with all of this is not to scare you, but just to inform you and hopefully move you to action to prepare for what's ahead. Now, a little bit about this video series to come. Beyond the near-term financial picture, we're going to look at the longer-term future that we're moving toward and how we might navigate it. We have some interesting challenges in front of us. Climate change, natural resource limitations, transition from old energy sources to new ones, and rapidly evolving technology that affects how and where we work. Through all of this, I'll be covering all aspects of personal finance and investing, offering actionable insights in plain English so you can live a charmed life through all of it. I'll be starting with the basics, but I'll also be covering advanced material throughout, so this should be of value to financial novices as well as seasoned professionals. Lastly, why am I doing this? Why am I talking to you here? Well, I earned a degree in economics and related fields, and I've been investing for my own account for over a decade and a half. And so I see the world through the lens of economics and finance, and I'm here to share that perspective. But more than that, I'm doing this because in my own life, I've enjoyed times of relative affluence, and I've experienced times of crippling poverty as well. And I've learned some hard life lessons throughout all of it. I'm here to help you, those of you who have a lot to lose in a major downturn, and as well those of you who have very little margin of error in your financial life. I've been there. I've done the deep research, so I hope to be able to help you understand and navigate the interesting times that we live in. So you ready for what's next? To catch the next video, just click like and subscribe below so you won't miss it. And keep an eye out for a new video every Wednesday around noon. That's what I'll be aiming for a publication date time. And since this is for your benefit, please use the comments below to tell me if there's anything specific you'd like to hear about in the coming episodes. Also, please share this on social media to see what your financially savvy friends think. I'd be interested to hear that as well. Yeah, let's get the conversation going. Now, lastly, a disclaimer. This material is offered for informational and educational purposes only. No part of this video constitutes personal, financial, or investment advice. I assume no liability for any losses arising from any financial or investment decisions taken based on the content provided herein. For personal financial advice, consult with your financial planner or your registered investment advisor. That's it for now. Thanks for watching. See you next time.